All right, let's set the stage. Picture this. It's early 2026. You're at your terminal, you've got your coffee, and you pull up the chart for Merck. That's ticker MRK, key 2. And if you just, look at the price and the headlines, it looks like a disaster movie. The stock is down. The sirens are just blaring about this 2028 patent cliff for their blockbuster drug, Keytruda. And then to top it all off, the company drops their 2026 earnings guidance. The EPS earnings per share is sitting in the $5 range, which is, well, it's just ugly.
On the surface, it's a horror show. I mean, it looks like a classic falling knife. You try to catch that, you can lose a finger.
Exactly. But here's the paradox. While the sort of retail crowd sees that earnings drop and runs for the hills, I'm looking at the capital flows from the institutional giants, the real smart money.
Right.
And they aren't selling. They're accumulating. They're treating this drop like a massive shopping spree that's just disguised as a bad quarter. So the question is, what do they see in the math that the headlines are missing?
They see a category error. Most people look at Merck and they see a pharmaceutical company.
Yeah.
They're picturing guys in white coats mixing liquids. And frankly, if that's your mental model, you probably should be selling. But if you look at what they're actually doing right now, under the hood, inside the clean rooms, they are not operating like a drug maker. They are operating like a precision engineering firm.
Precision engineering for a pharma giant. I mean, that sounds like a nice marketing spin, but does it really hold water?
It holds water and it holds the valuation. They are using molecular architecture and advanced chemical engineering to fundamentally restructure the entire asset. So our mission today is to decode that signal from the noise. Is Merck a falling knife? Or are we staring at a structural inflection point where the fundamental physics of the company are about to change?
Structural inflection point. I like that. It implies that the past doesn't predict the future here. But before we get to that future, we have to talk about the panic. The elephant in the room. The fortress. Keytruda.
The golden goose.
Right. For anyone who's been living under a rock, Keytruda is the best-selling drug on the planet. Massive revenue. But in 2028, the patent expires. That's the patent cliff. In my world, that's like being a landlord and losing your anchor tenant who pays like 40% of the rent.
The building collapses.
Exactly. The revenue just goes to zero. Why isn't this fatal?
It would be fatal, absolutely, if they were just relying on lawyers to find some loophole to extend the patent. But they're not. They're using engineering. Let's take a walk inside the lab because the solution is genuinely fascinating. It's called Keytruda QLEX.
QLEX sounds like a sci-fi villain.
Hey, it's actually the hero of the story. This isn't just a new label on the box. It's a completely different delivery mechanism. Subcutaneous injection.
Okay, break that down. Right now, if you need Keytruda, you go to a clinic, you sit in a chair for half an hour with an IV drip. It's invasive. This new version is just a shot under the skin. I get the convenience. But is convenience really enough to stop a patent cliff? When generic Keytruda comes out, it'll be cheap. Are insurers really going to pay a premium just so a patient saves 20 minutes?
And that is the mistake everyone makes. It is not about convenience, it's about the tech moat. Think of it this way. The competition is driving on a bumpy dirt road, and Merck just built a 10-lane superhighway that only they have the keys to.
Okay.
And to understand why, you have to look at the biochemistry. Merck is using a technology called ALTB4, and it's from a South Korean company called Alteogen.
Alteogen. Right, I remember that deal.
So here's the physics problem. Human skin is a fortress, a brick wall. It's designed to keep big things out. A biologic drug like Keytruda is a massive, complex molecule. You can't just shove it through that wall.
It won't fit. That's why you need the IV to bypass the wall.
Exactly. You go right into the veins. So how does this shot work? How do you get a giant molecule through a brick wall without, breaking the wall?
Yeah, how?
You don't shove it. You use a biological tunnel boring machine. ALTB4 uses a specific enzyme hyaluronidase to temporarily dissolve the mortar between your skin cells.
It dissolves the mortar.
Just for a moment. It creates this temporary microchannel, a literal tunnel through the tissue. It injects the drug, and then, and this is the magic part, the body instantly repairs the mortar. It's a precision breach, delivery, and seal.
Wow, a biological tunnel boring machine. That's a wild.
And here's the moat. By switching the delivery method to this high-tech enzyme process, they're not just changing the needle, they are resetting the entire patent clock. This new formulation, QLEX, has patent protection all the way to 2042.
2042, wait a second. The cliff is supposed to be 2028. So you're saying if they move patients to this new tech, they push the expiration date back by 14 years.
Precisely. And the goal, the internal operational goal, is to get 30 to 40% of patients switched over by 2028. If they hit that number, the cliff becomes a gentle hill.
And this is where it gets really smart from a capital allocation standpoint. I remember when the Alteogen deal was announced, the street was terrified. Everyone thought Merck would be paying this massive tax, huge chunk of revenue.
A huge royalty.
But the numbers came out. Do you know the royalty rate? It's around 2%.
Incredibly low.
They're paying pennies. I mean, think about that leverage. They are securing a fortress that generates over $30 billion a year, and they're doing it for a 2% maintenance fee. It's the ultimate hedge. They've engineered a way to keep their best tenant just by renovating the front door.
And giving them a private elevator. It's a win for the patient, a win for the engineer.
Okay,
Yep.
so that's defense. That keeps the lights on. But you don't get a valuation re-rating just by playing defense. You need growth. A new story. Let's talk offense. Let's talk about the new engine. Winrevair.
This is where we shift gears completely. We're moving from oncology to cardiovascular. And historically, this is where Merck has deep roots. Winrevair came from the Acceleron acquisition, and it treats a condition called pulmonary arterial hypertension, or PAH.
Right, high blood pressure in the lungs. A terrible disease, but from an investment view, it's usually seen as a niche market. Rare disease, limited patients, capped upside.
Usually. But you have to look at the mechanism. Old drugs for this condition are basically like widening a road. The blood vessel is narrow, so you force it open vasodilation. It helps, but it doesn't fix the broken road. It's a Band-Aid.
Okay, so how's Winrevair different?
Winrevair actually targets the root cause. It stops the cells in the vessel walls from proliferating, from thickening. It literally remodels the vessel structure. It's not just widening the lanes, it's fixing the pavement itself.
Root cause fixing. I like that. And the price tag reflects it, right? Something like $238,000 a year.
Per patient. A serious number.
It is. But here's the thing that was nagging me. The acquisition cost $11.5 billion for Acceleron. That seemed so steep for just a rare disease drug, I couldn't make the math work. But then I saw the recent phase 2 data for heart failure complications, specifically a condition called CP-CPH.
Right. Combined post and precapillary pulmonary hypertension.
It's a mouthful, but
Okay.
stay with me.
Yeah.
Because this was my epiphany moment. I was reading the clinical notes, and I realized there are currently 0 approved drugs for that condition. None.
0.
But Winrevair is showing positive data there. And suddenly, the $11.5 billion price tag makes perfect sense.
You see the connection?
Wait a minute. If they crack heart failure complications, this isn't just a niche lung drug, is it?
No. You've just spotted the pivot.
Holy cow. If they crack this, they aren't just replacing Keytruda revenues. They could potentially double their total addressable market in cardiovascular medicine. This builds a whole new pillar for the company.
That's the connector moment. That's why the institutional money is flowing in. Merck stops being just an oncology company. If Winrevair works for CP-CPH, and the data suggests it does, they're suddenly accessing a patient population that is 5 to 10 times larger than the original PAH market. They go from a specialized drug to a mass market blockbuster for heart failure.
That changes the entire equation. You go from a one-trick pony worried about a cliff to a diversified giant with 2 massive engines.
And that diversity is crucial because the oncology battlefield is changing too. It's not just Keytruda anymore. It's about the war room strategy for small cell lung cancer.
Right, the big face-off, Merck versus Amgen.
It's a fascinating technical fight. Amgen has a drug called tarlatamab, and Merck has ifinatamab deruxtecan. Let's just call it IDXD for everyone's sanity.
IDXD. Sounds like a weapon system.
It basically is. It's an ADC, an antibody drug conjugate. Think of it like a guided missile. Traditional chemo is carpet bombing. You kill cancer cells, but you kill healthy cells too.
Right, collateral damage.
An ADC is different. The antibody is like a heat-seeking missile that finds the cancer cell, lashes on, and then drops a toxic payload directly inside. Precision strike.
An Amgen's drug.
Amgen uses a BiTE molecule. It grabs one of your own T cells, a soldier from your immune system, and physically drags it over to the cancer cell to force a fight. Now, here's where the yield, the efficacy, comes in. Merck's IDX showed an objective response rate, or ORR, of roughly 48 to 56%.
Over 50% in small cell lung cancer. That's huge.
Yeah.
That cancer is notoriously tough.
It is huge. Amgen is hovering around 40%. But there's a nuance. Amgen's drug has a tail. The patients who respond tend to live for a long time, but it comes with a heavy cost. Cytokine release syndrome.
The cytokine storm. The immune system goes haywire.
Exactly. It can be fatal. Merck's drug has its own risks, like lung toxicity, but it hits harder and faster. And Merck made a very strategic choice here. They partnered with Daiichi Sankyo, a $22 billion deal to get this ADC tech.
$22 billion. That's not a partnership. That's buying the best weaponry on the market.
That's it, exactly. They saw ADCs are the future, the replacement for chemo. They didn't try to build it from scratch. They went out and bought the best platform to ensure they rule oncology post-2030. They're optimizing for yield.
Okay, so let's recap. Fortify the castle with Keytruda SC. Build a new kingdom in heart failure with Winrevair. And buy advanced weaponry for future wars. But this brings us back to the start. The ugly financials. The $5 EPS for 2026.
But you have to ask why it's ugly. It's ugly because they spent $15 billion on acquisitions. In accounting, that hits your earnings immediately. It looks like a loss. But it is accounting pain for future gain.
It's like saying you're broke because you just bought 3 apartment buildings with cash. You're not broke, you're just asset-rich and cash-poor for a month.
Precisely. And inside that shopping bag are these hidden gems the market is completely ignoring. Take Verona Pharma. Merck just picked them up. They have a drug called Ohtuvayre for COPD.
COPD. Huge market.
Massive. But the tech is the dual mechanism. It acts as both a bronchodilator to open airways and an anti-inflammatory, but without the nasty side effects of steroids.
So no weight gain, no bone density loss, none of that.
None of that.
That sounds like a sleeper hit. You plug that into Merck's sales machine.
And it becomes a blockbuster. Easy billion-dollar drug. And then there's Cidara. They have this molecule, CD388. It's a flu shield.
A flu shield, like a vaccine.
No, and that's the paradigm shift. A vaccine teaches your body to fight. This is the fight. It's a long-acting antibody. You get one shot, and you are protected for the entire flu season, immediately. For high-risk patients, this is a game changer.
So you walk out of the doctor's office already bulletproof.
Correct. And again, Merck bought it. It's just sitting there in the pipeline, undervalued.
Okay, let's do the institutional debate. I'm putting on my skeptical hedge fund hat. I'm the guy selling the stock.
Go for it. Give me the bear case.
The EPS is halved. The PE ratio is sitting at, what, 14 or 15 times? That's low for a reason. The market is saying, we don't trust the execution. What if the Keytruda switch fails? What if doctors just stick with the IV? What if the patent cliff is real and revenue actually vanishes? Why should I risk my capital on a company that's still under construction?
I'd answer by pointing to the manufacturing floor. Merck has implemented continuous manufacturing. We are talking 1,600 data texts per second monitoring the production line, a zero-defect mentality. And look at Valo Health.
The AI company they partnered with.
Yes,
Yeah.
using AI digital twins to simulate patient responses, cutting trial times, reducing failure risk. But if you want a hard money argument, just look at the cash flow.
The free cash flow.
Yes, the accounting earnings are low because of the shopping spree, but the free cash flow is jumping to over $20 billion. The cash register is ringing louder than ever. The dividend is safe. It's growing. The 2026 loss is just a shopping bill.
$20 billion in free cash flow. That's the truth serum. You can't fake cash in the bank.
Exactly. And if you want one metric to watch to tell you if the bull case is working, watch the switching rate.
The switching rate.
If Merck can convert just 15% of Keytruda patients to the new QLEX version by late 2026, the narrative of the patent cliff dies. 15% is the tipping point.
That's the signal. If we see 15% conversion, the falling knife becomes a rocket ship.
Precisely.
So let's wrap this up. Merck right now feels like a construction site. The scaffolding is everywhere. That's the low EPS. It looks messy. But if you look through it, the building underneath has a pipeline value of over $70 billion.
It's a company at a structural inflection point. The fundamental equation of how they make money and for how long is changing. When Winrevair and QLEX really start hitting the P&L, the math completely flips.
It's not a buy recommendation from us, obviously. We don't do that. But it is a recognition that the market might be mispricing the risk here.
The market hates uncertainty. Merck is currently in the business of manufacturing certainty.
I love that. Manufacturing certainty. So here's a provocative thought for you to chew on. We all hear about the patent cliff. Everyone thinks 2028 is the end of the world for Merck. But when the market finally realizes that this cliff has been engineered into a gentle hill, where do you think the valuation goes?
If the risk premium disappears, the multiple expands. It's as simple as that.
Simple as that. Look at the footnotes, folks. That's where the story is. Thanks for joining us on the Deep Dive.
See you next time.